the Fed's secret monetary tool. How do quantitative easing and quantitative tightening work? And what is the Fed doing right now? Hello everyone, and welcome back to Markets with Markus. I hope you're having a great week. So, today's question is, what's it with the Fed's balance sheet with quantitative easing and quantitative tightening? And is it really the secret sauce to the Fed's monetary policy? So with that in mind, we'll go step by step and look at three questions today. First, what rates does the Fed set and how does the interest rate pyramid work? 2, how do quantitative easing and quantitative tightening work? How does the Fed use its balance sheet? And 3, what is the Fed doing with its balance sheet right now? So let's jump in right now and begin with the first question. What rates does the Fed set and how does the interest rate pyramid work? So the Fed, as we're all familiar with, uses as its main monetary policy tool the Fed funds rate. That's a rate that we all know, we're familiar with. Currently, at the time of this taping, it's been 4% and 4.25%, so it's a range. And what it really is, it's not something that the Fed uses directly, so that's not a rate that you can go to the Fed and ask to borrow or lend you money at the rate, but it's a range for the rates that the Fed wants banks to pay each other when they deposit or borrow money overnight on an unsecured basis. So the background is that at the end of every day, some banks will have too much money and some will not have enough money. That's not in a capital sense. It's just where you just sold a lot of securities, bought a lot of securities, got a lot of deposits, had some client withdrawals. So most banks will just not end the day at zero. And in an orderly market environment, banks will now start to borrow and lend from each other. And the Fed wants to keep this activity between banks in this range. So how does the Fed set these boundaries? So at the upper end of the range, the 4.25%, for example, that we currently have, the boundary is the rate at which the Fed would lend money to the banks itself. So the discount rate, as this rate is called, is the rate at which the Fed lends money to banks. It's against collateral. It's not directly comparable, but most banks usually have collateral. So that's 4.25%. So any bank that needs money overnight knows for 4.25%, they can go to the discount window, they can get it. So they'll only go to another bank for overnight lending when it's cheaper. That's the upper range. And the lower range, that's the rate that the Fed pays for deposits. So banks get deposits on their minimum reserves. They can also access these deposits with a tool that's called reverse repos. It's essentially a deposit by another name. And the Fed currently pays, let's say, 4% there. A bit more complex, but generally that's the boundary. So a bank that has some money left knows they can get 4% from the Fed if they deposit it overnight with the Fed. But if they lend it to another bank, they can get a little bit more. And that's how the mechanism works. The two banks, the one that has a bit of extra money, the other one that needs a bit of extra money, split the difference between 4% and 4.25% among themselves, so to speak. Let's say in the middle at 4.125% or wherever, and they lend it to each other. That's what the Fed funds rate is. That's how it works. And it's relatively easy to control for the Fed, even with this traditional set of monetary tools, the discount rate and the interest rates on minimum reserve requirements and reverse repos. So that said, this rate, the Fed funds rate, is only the beginning of what I call the interest rate pyramid. It's actually an inverted pyramid that stands on its head, so to speak. So the basis for all our interest rates out in the market is the Fed funds rate. That's the basic rate that the Fed manages, as we said, that it controls directly, and that is more or less one observable rate. Again, the banks negotiate, but it's in a tight space. It's relatively close together, so that's well managed. But then a lot of different other rates pile on top of each other, are derived from that base rate, so to speak. You can imagine it maybe like a human pyramid. Now you have a base, you have someone standing firmly at the bottom, but then you have people piling up, building a human pyramid, a human tower. The higher up you go, the more confusing it gets, the more shaky it gets, the less clear it is what's going on. That's how interest rates work in real life, in a way, if you want a picture. So on top of the Fed funds rate, you then have the wholesale short-term rates, T-bill rates for those of us who invest in Treasuries. They're still pretty close to the Fed funds rate, but you also have certificates of deposit, commercial paper in the private sector. Still close enough, still more or less controllable, but already with some slight market movements. Then the next step removed is still wholesale medium and long-term rates, rates that in the professional markets are being charged. For example, when treasuries are being issued, when corporate bonds, munis, agencies, all types of bonds are issued, or also large loans among wholesale institutions, among professional institutions. And then ultimately you have the retail rates, rates that banks charge to people like you, like me, that will be for car loans, mortgages, credit cards, what have you. And those rates will still ultimately be derived from the Fed funds rate, but it's not always a direct link. And as we've seen also in the past few weeks and months, the further up you go this pyramid, the more the rates are not set by what the Fed does at the short end, but the more it's set by supply and demand, the more it can diverge. Now, we've seen that Fed started lowering rates at the short end. Treasuries have been going up at the long end in the past few weeks and months. And that comes from the simple equation of supply and demand. How do markets judge the development of the economy, the credit quality of the individual borrower? There are many factors that influence that. Plus, most of these retail rates and the long-term rates in the wholesale market do not directly base themselves, do not directly reference the Fed funds rate, but really reference some other benchmark rate. Now, the 10-year Treasury yield is very often a benchmark that wholesale markets follow, or the SOFR, another commercial benchmark for interbank lending, professional market lending, or the prime rate. That's a widely followed benchmark for the retail market. That's the rate you give to your best customers, so to speak, and then you look at credit quality and personal circumstances. So that's how it works. The Fed controls the short end. At the long end, it gets a bit more confusing, chaotic, the further away you go, harder to control, and sometimes, as we said, it can move in different directions. This leads us neatly to the next question. How do quantitative easing and quantitative tightening work? So, in other words, how does the Fed use its balance sheet to manage the amount of money in circulation? Using the balance sheet to manage the amount of money in circulation is a fancy technical way of saying that the Fed creates more money, withdraws money, what you would have called in the old times prints money or withdraws banknotes. Now it's just all electronic now, it's not physical banknotes anymore, but the basic idea is still the same. Now you can understand the concept if you think of physical banknotes. The balance sheet management, the tightening, the easing, does not replace the traditional monetary tools, the rates we discussed before. We know the Fed funds rate is still around, the discount rate is still around, reverse repo rates are still around. But an additional tool that the Fed has, and the Fed likes it. It has, I think, three main advantages that come to mind. The first one is, whereas the Fed funds rate, by definition, only works at the short end, it leaves the long-term end pretty much to its own devices, which you can like or not, but if you're the Fed, you want to influence it. Quantitative easing or tightening gives you the tool, the possibility to manage long-term rates more directly, because you can buy or sell long-term bonds, influence that a bit, so you hope you can have a bit more influence directly at the longer end of the maturity range. Quantitative easing in particular is also a popular tool during financial crisis or other special situations. The Fed used it extensively during COVID and before that in the great financial crisis, because printing money, so to speak, helps. It calms people down. It greases the wheels of the financial system before it starts to seize up in a crisis. And it's a very powerful tool for that, and probably more directly effective even than just lowering interest rates. So it supplements that. And finally, because it's very technical and it works very indirectly, you could also sometimes think that it works more smoothly than a direct rate change. Nothing is really announced. But now you hear sometimes in the markets that the balance sheet management is the secret weapon of the Fed, because it works more indirectly, it allows them to be more targeted, and that without being so clearly in the public focus and spotlight like an official change to the Fed funds rate. So how does it work? Let's start with quantitative easing. That's how it usually starts. And technically, quantitative easing is when the Fed buys large amounts of bonds. And that's what we call money printing. So a bit of a background to that. I think you need to keep in mind here that when you or I buy something, let's imagine we have a $20 note, we buy something, we don't create that money and we don't destroy it. Now, we got this $20 bill from someone before, maybe as a wage or from a deal or transaction or as a gift. Then we buy something with it and the money just changes hands. We don't have it anymore, but it's still in circulation. So we as individual customers, as individual retail participants in the economy, don't create or destroy money. The Fed is different from you and me here, because when the Fed buys something, they essentially create their own money. Easiest to imagine, they print their own bills and then they go out and buy something, and then there's more money in circulation than before. Those new bills are now in circulation. The Fed owns something, yes, but there are also a few more brand new bills out there. Now, these days it's all electronic. It's not really printing anymore, but the principle is still pretty much the same. So if the Fed buys something with newly printed money, there's more money out there that eases credit and has a tendency to lower interest rates. And if in doubt, it'll be slightly inflationary. More money out there chasing the goods. Now, as a result of the Fed buying something, the Fed owns something. In real life, what the Fed buys is usually US Treasuries and agencies, so very high quality bonds that are usually backed up by the full faith and credit of the federal government, and or if it's like mortgage-backed agencies, in addition by collateral, by the mortgages. The Fed doesn't really buy or sell with retail customers directly. They keep to the circle of primary dealers, so very large banks. But again, the principle is the same and they then transmit it. So at the end of a quantitative easing cycle, there are more banknotes, so to speak, out in circulation. There's more money out there, but the Fed owns more assets, in this case, usually more treasuries or more other bonds. And those bonds need to be recorded on the Fed side. They show up on its balance sheet. That's like nothing else than a register of the things the Fed owns. So quantitative easing, more cash in circulation, more assets that the Fed owns, more treasuries, more other bonds. The flip side of that is quantitative tightening. That's the large-scale selling of bonds by the Fed, the money withdrawal, so to speak. I couldn't come up with a better word, but money withdrawal is probably still the best. Burning money doesn't really work so well, I guess. You don't really burn it. But what happens is, in quantitative tightening, the Fed now sells those bonds again back to the market, to the primary dealers. They make a good price, someone buys it, and pays for the purchase with cash. So the cash, don't forget, the Fed is different from you or me. is now not just kept by the Fed, it's not kept in circulation, but it's withdrawn from circulation. No? Imagine it, the bills that the Fed has don't get spent again, they go into the vault, or if it's electronically, it can just be taken out. So that means as a net effect of quantitative tightening, there's less money in circulation. Less money in circulation generally means tighter credit, tendentially higher interest rate, and it generally has a dampening effect on inflation. Less cash out there chasing the goods. On the other side, because the Fed has now sold their assets, the Fed balance sheet shrinks. The money that the Fed gets withdrawn, so it doesn't register on the balance sheet, so the Fed shrinks its balance sheet. It owns less. That's where the name quantitative tightening comes from. So those were really the two mechanisms, buying or selling assets to get more or less cash in circulation to either help or dampen, slow down, if you want, the economy. So, and this leads us to our next question. What is the Fed doing with its balance sheet right now? Or maybe to give a bit of context, what has the Fed recently been doing and what are they doing right now? So for those of you who can see the chart, what you can see here is that when COVID struck in early 2020 and the economy was about to seize up and enter depression, the Fed reacted not only by lowering rates very fast and very steeply, but also with quantitative easing, by injecting liquidity into the economy or by printing cash, as we just explained. So what you see here, this curve shows you the Fed balance sheet. Again, that's the register of the assets, the bonds the Fed owns, and that shot up. First very steeply, then it kept trending up until early 22, middle of 22. At this point, this quantitative easing went in parallel and supported what the Fed did with the rates. Both the liquidity injection, the cash printing, and the lower rates stimulated the economy, helped the economy to digest and smooth over the initial COVID shock, to revive again, to get lower rates, easier credit in the economy. But yes, it was also inflationary on both fronts. So when inflation did become a problem, the Fed reversed course. As we can see here, it was middle of 22-ish, inflation was a record high. That's when the Fed started to increase rates again to fight inflation. And at the same time, they also switched their balance sheet policy from monetary easing to monetary tightening. Or in other words, they were starting to withdraw cash from the economy by selling some of the assets they had bought before, as we just discussed. So at this point, at the beginning of it, higher rates and quantitative tightening worked again in the same direction. Less liquidity, tighter credit, higher rates, slowing down the economy a bit, but also fighting inflation, this inflationary policy, if you want. And that was in parallel for a while, but there was a certain disconnect that started in the last quarter of 2024, when the Fed started lowering interest rates again, so relaxing that, but continued the quantitative tightening. So in a way, two of the main tools of the Fed were working against each other. Lower interest rates before switched into higher interest rates, dampening inflation, bringing it down, and then the Fed started lowering again. So this whole curve that we remember from the interest rates was initially parallel between the monetary policy and the interest rates, but at the end, they didn't switch the monetary tightening. So they kept tightening the balance sheet, reducing the amount of cash in circulation, while they were already starting to lower rates again. That's a contradiction. Lower rates stimulates the economy. Yes, that's what they wanted, but continuing to tighten the monetary policy has basically the opposite effect. So a bit of a contradiction. So we'll see how long that stays. We'll talk about that later in a bit. But it's also clear that tighter monetary balance sheet policy while continuing to lower rates makes not much sense from a purely technical perspective. So before we discuss that, two more comments. One comment is you see, and that it's very common to see that the quantitative easing in a crisis is usually much steeper than the quantitative tightening after. So in other words, now if I say it in my words, it's very easy to pump a lot of money into the economy. No one's really complaining at that point. It's very hard to withdraw it because people are getting used to that extra money. No one likes when it's being taken away from time to time. Now the Fed needs to slightly adjust. Now you can see here this slight uptick again in early 23 when people get nervous. The Fed needs to reverse course for a while so that there's not a shortage of liquidity in the market. And usually it doesn't really go back to where it was before the crisis. That's a bit like prices. Now, even when inflation stabilizes again, prices never go back to where they were before. This is pretty much the same with Fed balance sheets. No? And the second comment, because people were asking, so what is the Fed really buying? So that is relatively transparent as always. No? The Fed publishes every week the domestic security holdings that they have in their program, their open market program. That's what we see here. And we see that they've built a sizable portfolio, sizable holdings of US Treasury notes and bonds, so the medium and long-term maturities. T-bills are relatively small. We're not surprised, because T-bills at the short end follow the Fed funds rate pretty directly, so there's probably not much need for additional intervention. Little fine-tuning is always good, but they really focus their interventions at the medium and long-term end, and they also build a sizable amount of agency mortgage-backed securities. Presumably, I wouldn't be surprised if part of the motivation was to stimulate the mortgage market, make sure, even though mortgages got much more expensive, as many of us know, to make sure it doesn't completely seize up. So in total, the open market program, now the Fed holdings on the balance sheet, the numbers we saw before on the chart as well, are more than $6 trillion. That's a lot of money. And it happens to be roughly 10% of all outstanding bonds in the US. So the US bond market, roughly 60 trillion at the time of this taping, of which a bit more than 6 trillion, as you can see here, are on the Fed balance sheet, owned by the Fed. So that's a sizable amount. And the Fed clearly needs to be careful what it does with it. It just can't dump it all on the market, even if it wants to shrink its balance sheet again. That could already have massive impact. So that said, what comes next? As we said before, currently the balance sheet policy and the rates are in a bit of a contradiction. Rates already coming down, looser monetary policy, tightening continuing, a bit more tightening. So the market expects overall to switch to a looser monetary policy. That we discussed that on this channel several times. That's because the Fed is getting more and more concerned about employment. It tends to prioritize that, or has been tending to prioritize that over inflation fighting and monetary stability, if in doubt. Clearly they hope to achieve both. And the markets expect that this will continue. The first step, and Chairman Powell has been hinting at it, is that he's been saying publicly recently that he sees the end of monetary balance sheet tightening coming. And the markets also expect another reduction in the Fed funds rate, with whatever that means for the long-term rate. So that's where we stand. I hope that helped you understanding a bit how this secret monetary tool, the balance sheet mechanisms, work for quantitative easing and quantitative tightening, how and why the Fed is using it, both to influence the overall monetary conditions, but also in particular to be able to maybe influence a bit the longer end of the range, and also where this might be going and what that means. So drop me in the community a note below, whether that's something that you found interesting, what your perspective is, whether you expect more monetary easing to follow after the next FOMC meeting on October 28th and 29th, or whether you expect more stability. Looking forward to all the comments and the discussions, and see you soon again on our channel or for the next piece with Markets with Marcus.